Have you ever wondered how your investment would have fared if you had invested in Dell in 2018? Let's take a step back in time and explore this scenario. If you had put $1,000 into Dell stock back in 2018, you would be sitting pretty today. Fast forward to March 2024, that initial investment would have ballooned to a whopping $4,693. That's a staggering 369% increase from your original investment. Now, let's put that into perspective. Imagine a seed planted in fertile soil. With the right amount of sunlight, water, and care, that seed sprouts and grows into a towering tree. Your investment in Dell has followed a similar trajectory, growing exponentially over the years. This growth hasn't been a steady uphill climb though. Like any stock, Dell's has seen its ups and downs, its periods of drought and abundant rainfall. But overall, the trend has been unmistakably upward. This isn't just a case of a rising tide lifting all boats either. Dell's performance has outshone the broader market. The tech giant's relentless focus on innovation, strategic acquisitions, and a successful pivot towards more profitable sectors of the tech industry have all contributed to its stellar performance. In the grand scheme of things, your $1,000 investment in Dell would have grown at an average annual rate of 36%. That's a rate of return that would make even the most seasoned Wall Street investors sit up and take notice. But the question that's likely on your mind is, what fueled this impressive growth? What were the key drivers that propelled Dell's stock to such dizzying heights? Well, the answer to that involves delving into the intricacies of Dell's financial performance, its revenue breakdown, financial health, cash flow, and other key indicators. That's a 36% annual increase. But what led to this impressive growth? To answer that question, join us as we peel back the layers and delve into the financial story behind Dell's impressive stock performance. Let's break down Dell's financial performance to understand the factors behind its stock growth. Starting with revenue, Dell saw a mixed bag from 2018 to 2023. The highest point was in 2021, with a significant 16% growth from the previous year. However, the years that followed saw a downward trend, with a 2% decrease in 2022 and a substantial 14% decrease in 2023, making it the lowest revenue year in the last 6. Now let's move on to Dell's profit margin. In 2023, Dell's gross profit margin was 23%, a decrease from its 5-year average of 27%. The two largest expenses for Dell following the cost of revenue were research and development, taking up 3% of the revenue, and selling general and administrative expenses consuming 15%. Despite the decrease in revenue and profit margin, Dell's net profit margin maintained a steady 3%, matching the 5-year average. This shows that Dell has been able to keep its profitability stable, despite fluctuations in revenue. Digging deeper into net profit, we see a year-over-year increase of $200 million from 2022 to 2023. Although this is a significant increase, it falls short of the $5.6 billion net profit recorded in 2021. However, it's important to note that despite these yearly fluctuations, Dell's net profit has been on an overall upward trend since 2018. While Dell's revenue has seen some fluctuations, its net profit shows an overall upward trend. This indicates that Dell has been focusing on increasing its bottom line and improving its profitability, which is a positive sign for investors. With a consistent net profit margin and an upward trend in net profit, Dell's financial performance paints a picture of a company that is able to navigate through challenges and maintain its profitability. Now, where exactly does Dell's revenue come from? This is a question that often pops up in the minds of investors. Dell's revenue stream is far from being one-dimensional. The company manages to generate its income from a wide range of sources, ensuring a diverse and stable financial structure. Firstly, there's servers and networking. This segment contributes to about 19% of Dell's total revenue. The company provides a broad range of server and networking products to cater to the needs of different businesses, from small startups to large corporations. Next up is storage, which accounts for around 18% of Dell's revenue. The company offers various storage solutions including data protection and backup, software-defined storage and more, catering to a wide array of customer needs. But the lion's share of Dell's revenue comes from the commercial client segment, which contributes a hefty 46%. This segment includes sales of notebooks, desktops, and workstations to corporate businesses. The high percentage underscores Dell's strong presence and credibility in the corporate world. Meanwhile, the consumer client segment, which includes sales of notebooks, desktops, and other products to individual consumers, contributes to about 11% of Dell's revenue. This highlights Dell's ability to cater to the needs of both corporate and individual customers. Finally, there's the others category, which makes up about 6% of Dell's total revenue. This includes a multitude of services such as cloud solutions, software, and peripherals, among others. This segment, although smaller in comparison, adds to the diversity of Dell's revenue sources. So in a nutshell, Dell's revenue comes from a diverse range of sources, with commercial client being the largest contributor. This diversified revenue structure not only reduces the company's dependency on a single segment, but also provides multiple avenues for growth and expansion, making Dell a potentially attractive option for investors. How healthy is Dell's financial situation? This question takes us straight to the heart of the matter, the company's overall financial well-being. Taking a closer look at Dell's total assets, we can see a slight contraction from $90 billion in 2022 to $83 billion in 2023. Net assets, on the other hand, have shown a slight improvement, moving from negative $3 billion in 2022 to negative $2.6 billion in 2023. While an improvement, it's important to note that negative net assets could indicate a company's outstanding liabilities exceed its total assets, which is a sign of financial distress. More concerning is the equity to total assets ratio. In both 2022 and 2023, this figure stood at negative 3%. This negative ratio signifies that Dell's liabilities surpass its assets, which can be a red flag for potential investors. Switching gears, let's delve into the liquidity ratios, starting with the current ratio. The current ratio is a financial metric that indicates a company's ability to pay off its short-term liabilities with its short-term assets. In 2023, Dell's current ratio was 0.76, a slight decrease from 0.82 in 2022. This lower ratio suggests that Dell may have difficulty paying off its short-term liabilities. Next, we have the quick ratio. The quick ratio is a more stringent measure of liquidity, as it excludes inventory from current assets. In 2023, Dell's quick ratio was 0.69, again a slight decrease from 0.73 in 2022. Like the current ratio, a lower quick ratio can indicate potential liquidity issues. In summary, while Dell has shown some resilience in its net assets, the overall picture raises some concerns. The negative equity to total assets ratio, coupled with the decreasing current and quick ratios, suggests that Dell's financial health does face some challenges. Dell's financial health shows some challenges with a negative equity to total assets ratio. Let's delve deeper into Dell's cash flow and DuPont analysis. In the world of finance, the cash flow of a company is a critical indicator of its financial health. Cash flow in its simplest form is the money that is moving in and out of a business. For Dell, the operating cash flow for 2023 was $7.1 billion. This represents a significant increase compared to the previous year. Similarly, Dell's free cash flow, which is the cash a company generates after accounting for capital expenditures, also showed a strong growth. In 2023, Dell's free cash flow was $5.1 billion. However, to gain a more comprehensive understanding of Dell's financial performance, we need to look beyond just cash flow. This brings us to the DuPont analysis. The DuPont analysis is a technique that breaks down return on equity, ROE, into three components: net profit margin, asset turnover, and equity multiplier. It allows us to examine the source of returns and understand the company's operational efficiency, asset use efficiency, and financial leverage. For Dell in 2023, the ROE was negative 108%. This was driven by a net profit margin of 3%, an asset turnover of 1.02, and an equity multiplier of negative 32.04. This means that while Dell was able to generate a profit from its revenues, it had a high degree of financial leverage, which led to the negative ROE. Comparatively, in 2022, Dell's ROE was negative 80% with a net profit margin of 2%, asset turnover of 2.3, and an equity multiplier of negative 29.87. In conclusion, while Dell's ROE has been negative, indicating issues with financial leverage, it's important to note the strong growth in operating cash flow and free cash flow. These figures suggest that despite the challenges, Dell has been successful in generating cash from its operations. While Dell's ROE has been negative, its operating cash flow and free cash flow show strong growth. So what does all this mean for potential investors? In the past 6 years, Dell has shown a remarkable growth of 369%, transforming a $1,000 investment in 2018 into $4,693 by March 2024. Despite some fluctuations, Dell's revenue and net profit have overall been on an upward trajectory, and its diverse revenue structure provides a strong backbone for its financial stability. However, it's not all roses. Dell's financial health metrics, including its current ratio and quick ratio, have shown some decline. Moreover, its net assets have stayed in negative territory. Despite these challenges, Dell's robust operating cash flow and free cash flow in 2024 demonstrate its ability to generate profits and maintain liquidity. Its DuPont analysis also reveals a complex interplay of factors influencing its return on equity. Remember, investing always carries risks, so make sure to do your own research. Don't forget to subscribe for more company analysis videos. If you'd like us to analyze a specific company, let us know in the comments.